When you borrow loan, it is difficult to compare different loans because they have different interest rate, charge different fees. For example, one loan may have a lower interest rate, but they charge a higher fees. So we use annual percentage rate to compare the rate for different loan. Annual percentage rate is a yield which brings the future payment stream back to the present value. So it exactly equals the net cash disbursed by the lender. Choosing Lending Act prevents lender from advertising a lower rate and hiding the other fees. But it is still confusing sometimes because different practice by the lender to present or show the fees to different borrowers. What is included and not included in annual percentage rate? Generally, annual percentage rate calculation will include points. Points is the money borrower paid to the lender to buy down interest rate. It's usually a percentage of the loan. Prepaid interest rate. Origination fees, including loan processing, underwriting, and documentation prepare fees and attorney fees. Closing agent document preparation fees and private mortgage insurance. Sometimes loan application fees and life insurance are also included in annual percentage rate. But generally, appraisal fees, home inspection, credit report costs, and title fees are not included in annual percentage rate. Late charge must be disclosed by the Choosing Lending Act. In California, it cannot exceed 10% of the installment due, and it cannot be collected unless the payment is not made within 10 calendar days after the due date. Lender may offer different loan options with different interest rate, upfront fees, and points. So annual percentage rate offers the direct way for us to compare these options, which takes into account of different costs and originations beside the interest rate only. Now let's calculate annual percentage rate for loan A and loan B step by step. If you want to borrow $200,000, there are two options, loan A and loan B, available. Both loans have 30 years maturity. Loan A, the annual contract rate is 6.5%. It has 1.5% upfront fees and 1% upfront mortgage insurance fees. Loan B have a lower interest rate. It is 6.25% annually, but it charges a higher upfront fees, 4% of the loan amount. Loan B has upfront mortgage insurance fees, 1%. How do we calculate annual percentage rate, taking into consideration of all these costs? There are two steps involved to calculate annual percentage rate. In the first step, we solve the monthly payment. In the second step, we can solve the annual percentage rate using the rate function. So in the first step, to calculate the monthly payment, we know the monthly interest rate is 6.5% divided by 12. Number period equals to 30 years times 12 months every year is 360 months. The present value is $200,000. Future value is 0 because it's fully amortized loan. We can compute the monthly payment will be $1,264.14. Please note here, to calculate the monthly mortgage payment, we will use the loan amount, the contract interest rate, the loan term, and future value specified in the mortgage contract. Now let's look at what is the real cost of borrowing, the annual percentage rate. To calculate annual percentage rate, we know the monthly payment is $1,264.14. It is negative value because it is a cash outflow for the borrower. The number period equals to 360 months. The present value is $195,000. So the present value to calculate annual percentage rate is the net amount of money borrower really get from the bank. We need to subtract the upfront fees paid to the bank from the loan amount to get the net amount of money borrower really get. So in this case, it's 1.5% upfront fees and 1% insurance fees. So the present value borrower really get is $195,000. future value equal to 0, we can compute the interest rate. So the interest rate is 0.5621% every month, times 12 give us 6.7452% every year. That is the annual percentage rate of loan A, taking into consideration of the upfront fees borrower paid to the lender. Now we follow the same procedure to calculate the annual percentage rate for loan B. Using the information for loan B, the annual interest rate is 6.25%, divided by 12 to get monthly interest rate. Loan B has a monthly mortgage payment of $1,231.43. To solve for the annual percentage rate, Loan B has a monthly payment of negative $1,231.43. The number period is 30 years, 360 months. Present value is $190,000, which equals to $200,000 minus 4% upfront fees and minus 1% mortgage insurance. So the net amount of money borrower gets from loan B is $190,000. We can compute the monthly interest rate is 0.5619%, so the annual rate is 6.7428%. We can observe that loan B had a lower interest rate than loan A, which leads to a lower monthly payment of loan B. However, borrower has to pay more upfront fees for loan B, 4%, in order to enjoy this lower monthly payment. Annual percentage rate calculation suggests, taking into consideration all the fees, loan B costs a lower rate of borrowing, 6.7428%, compared to that of loan A at 6.7452%. This is true if the borrower holds the loan for 30 years until maturity. Annual percentage rate is superior to interest rate alone in comparing the cost of loans, taking into consideration all the upfront fees. But it assumes the upfront fees will be spread over the full maturity of the loan, which is usually not true. Borrowers are very commonly prepay their loan before the maturity. So what shall we compare if borrowers prepay the loan before the maturity? We use the term effective cost of borrowing if the loan has been prepaid before the maturity. It involves 3 steps to calculate the effective cost of borrowing. In the first step, we still need to calculate the monthly mortgage payment. We use the loan amount, contract interest rate, loan term, and future value in the mortgage contract. And then because the loan is prepaid, we need to calculate the future value at the time of prepayment. Because the borrower prepaid the loan before maturity, we need to calculate the outstanding balance at the time of prepayment, which is the future value. To calculate future value, we use the original loan amount, contract interest rate from the mortgage terms, monthly payment calculated from the first step, and the prepayment period. In the third step, we calculate the effective cost of borrowing. We use monthly payment from the first step, future value from the second step. The number of period will equal to the prepayment period. For present value here, we need to subtract upfront fees paid to the bank from the loan amount to get the net amount of money borrower really get from the bank. Now let's look at the same option, loan A and loan B. Let's assume if we hold the loan for only 5 years, which one is a better choice? In other words, which one has a lower effective cost of borrowing? First, for loan A, we can calculate the monthly payment, which is $1,264.14. We use the contract interest rate, loan terms, and loan amount from the mortgage contract to do the calculation. In the second step, in order to solve the future value at the end of year 5, the monthly payment equals to $1,264.14. Number of period equals to 5 years, which is 60 months. Present value is $200,000. The contract interest rate is 6.5% every year, divided by 12 to get monthly interest rate. We compute the future value at the end of year 5. So the future value outstanding balance for loan A at the end of year 5 is $187,000. $1,222.54. Again, the future value is the amount of money which will be paid to the bank. So that is a cash outflow. It's a negative number here. In the third step, we solve the effective cost of borrowing. So the monthly payment is $1,264.14, which is a cash outflow. It's a negative number. The number period equals to 5 years, 60 months. Present value is $195,000, which is the loan amount subtract upfront fees and mortgage insurance. It gives us a net amount of money borrower get from the bank. The present value is negative $187,222.54. That is the negative number. It's outstanding balance paid to the bank at the end of year 5. So we can calculate the effective cost of borrowing. The rate is 0.5927% every month times 12, which gives us 7.1128% if we hold this loan A for 5 years only. Now let's look at the effective cost of borrowing for loan B. For loan B, we calculate the monthly mortgage payment is $1,231.43. Use a contract interest rate, loan maturity, and mortgage amount from the mortgage terms. In the second step, we calculate the future value for loan B at the end of year 5. So the monthly mortgage payment is negative $1,231.43. Number period equals to 60 months. Present value is $200,000. Monthly interest rate is 6.25% divided by 12. The future value for loan B at the end of year 5 is $186,674, which is again a negative value because it is a cash outflow. To solve the effective cost of borrowing for loan B, the monthly payment is $1,231.43. It is a cash outflow, a negative value here. Number period equals to 60 months. Present value is $190,000, which is $200,000 loan minus 4% upfront fees minus 1% upfront mortgage insurance. The future value at end of year 5 is from step 2, which is $186,674. We can compute the monthly rate is 0.6240%. The annual rate is 7.4877%. Effective cost of borrowing calculation suggests if borrower only holds the loan for 5 years, loan A costs a lower rate of borrowing, 7.1128% compared to that of loan B at 7.4877%. Although loan B has lower monthly payments than loan A, but loan B asks for much more upfront fees than loan A. So when the holding period is shorter, the cost of upfront fees will outweigh the benefit of lower mortgage payment. Loan B will cost at a higher rate. The graduated payment mortgage. In graduated payment mortgage, interest rate is again fixed, but the payment will gradually increase at a predetermined rate. So there are no uncertainty about interest rate or monthly payment. Why? Because graduated payment mortgage has an increased mortgage payment. It's a better match between borrower's future income and payment. Usually borrowers start with a lower income, which grow over time. So the income and mortgage payment start at a lower amount together and grow over a long time. It's a better match. And it's easier for borrower to qualify because they start with a lower mortgage payment. They need a lower income to qualify for the loan. But for graduate payment mortgage, there is a possibility of negative amortization, which happens when the monthly payment is so low it's not even enough to cover the interest rate charged by the bank in that period. So the difference between interest charged by the bank and the monthly payment will become accumulated on top of the loan balance. We observe the loan balance grows over time. If we compare the default risk of graduate payment mortgage versus fixed payment mortgage, the probability of default is higher for graduate payment mortgage because it has a higher likelihood of negative amortization. and the expected loss in case of default will also be higher because the outstanding balance is growing over time. A mortgage can be thought as a risk-free bond plus two possibilities, which increase risk to the lender: default risk or prepayment risk. Historically, the risk of default adds about 0.25% to the interest rate. The remaining spread of the mortgage rate over the treasury yield represents the risk of prepayment and the underwriting cost.